Bob gets what he deserves. We will have a new updated Bob beating very soon. How you doing, folks? Today, I'm going to talk about the trade that we made in 0 DTE. Now, if you don't know what 0 DTE is, that is a kind of day trading with options on the S&P, the Standard & Poor's 500 index. And we have this opportunity 3 times a week, Monday, Wednesday, and Friday. Unlike most options that expire either weekly or monthly, the S&P index, the options on the S&P, they expire 3 times a week. Now, that's pretty important because it gives us a lot of advantage being able to trade on the very last day of that expiring time, because premium on that day is moving super fast. And so if you're selling premium, you have a distinct advantage, unlike most day trading where you have no advantage. So today, now we do this 3 times a week. You can expect to see me here Monday, Wednesday, and Friday, usually somewhere around 1 or 2 p.m. Eastern time. And I'll talk about the day's trade. The S&P just took off today. Now, I anticipated that last night when I put on our 0 DTE trade. Now, you may be wondering, oh, Ernie, didn't you say that this is a day trade? Shouldn't I have to wait for the market to open? Well, there are 3 different ways to trade the 0 DTE, 0 days to expiration. You can trade options on the SPY, which I think most of you are familiar with, and certainly you couldn't open up a trade until the market opens at 9:30. You could open up a trade on the SPX index, options on the SPX index. Still, you wouldn't be able to open it up until 9:30. Or you could open up a trade on the E-mini S&P futures contract, which you can open up just about any time that you want. In fact, today's session, actually opened up at 6 p.m. last night. So, last night around 10 o'clock, I was looking at the S&P and I noted that it looked pretty interesting. And I can show you that here. Hold on a second. Get the chart. Just one sec. Should have been prepared, but I wasn't. Got to take these studies off. There we go. There we go. So last night, so here we are, Sunday. This is when the Sunday session opens at 6 o'clock. And what you're seeing here leading into Sunday, that's actually Friday session closing. So Sunday started a little bit down, but it started to move sideways. Then right around here, 9 o'clock, actually it was 10 o'clock that I looked at it, and I noticed that it had moved up very sharply. And that move is pretty significant. That was telling, and you can see that even for Sunday night, although it's hard to tell here relative to the other volume, there was a fair amount of volume that came in there. And so that tipped me off that we were going to have an up day. Of course, it's not much of a tip because virtually every day on the S&P in this market, with the Fed instituting their quantitative easing, and every day is just about an up day. But this was a good indicator. So what I decided to do was put on a trade right then and there. And of course, we held that right into, we didn't hold it all the way up until now, but we got the majority of the move, got out right around 39.25 or so, right around here. So it was a substantial win for us today on the 0 DTE service. Now, I should say, the way I conduct this service. Now, first of all, you couldn't do this with options on the SPY or options on the SPX, because you would have had to have waited until 9:30, which would have been right here, and you would have missed all this profit from here down to here, substantial, and all the credit that you could have accumulated because of the time difference. So you would have entered here with a spread, a credit spread, probably with a great deal of risk. When I entered here, I entered with a total of $60 risk with a potential of $600 upside. Now, that in of itself, if you are familiar with the 0 DTE trade and you have followed other people who are, hey, let me get the big head back here. Oh, it's not enough, Bob. We've had enough of Bob. So I call my strategy the inversion of risk. And if you heard what I had just said, I said that I had a risk of $60, but an upside potential of $600. That's a 1 part risk to 10 parts profit. Now, in the 0 DTE world, in what everybody else is doing in terms of their 0 DTE strategy, that is unknown. They simply do not do that at all. As a matter of fact, it's usually quite the opposite, 10 times risk than profit. Of course, your probability of profiting is pretty high, but when you don't profit, you get slammed. And I mean hard. Now you might think, well, if you have inverted it, Ernie, do you have a very low probability of profit? No. That's the key here. The way we do it, we have, I think, even a better chance of profiting and an order of magnitude chance of losing money. Order of magnitude chance of not losing money, I guess that would be the right way to say it. And then the amount of money that we lose is, 1/10, 1/5 to 1/10 of what they lose. So we win more often. We have a greater opportunity to make huge wins. And when we lose less often with less money. And that is the inversion of risk strategy that I teach in my service. You might say, but Ernie, how do you do that? Well, that's part of the service, right? The benefits are that you can be in the service and get an alert, put a trade on, and not sweat it. Where do we see the idea you published yesterday? Where do you see it? I'll show you in a second. Where do you see the idea that I published yesterday? I don't know exactly what that question means, but I didn't publish it to the world. I published it to the service, and we have a private Discord group, and that's where all of the activity happens. So in the Discord group, we talk about the strategy, the build up to a particular trade, and then I'll put an alert out in that group. And people can either watch it on their computer or they can have it on their phone and get alerted. Now, what most people do with the 0 DTE, besides the fact that they don't have the ability to trade whenever they want, They have to wait until the cash market opens, and thereby limiting the amount of profit that they can get, and also basically handcuffing them into an extremely risky trade. The way they normally do this is they'll put on either a spread, a credit spread, typically with a very high probability credit spread. And this terminology might be foreign to some of you, but it's typically a 5 to 6 delta, which means that it's about a 95 to 94, 94 to 95% probability of profiting trade. Then, because they're so worried about that trade going against them and then going into the risk area, which is typically huge, right? So you might be, in other words, let me just give you an idea. You might put on a trade where you're trying to make $25, but you're risking $500. So if the trade starts going against you, all of a sudden you're underwater, $75, $100, $200. And then if you end up completely in the risk area, you could lose $500, which could easily wipe out a month, 2 months worth of gains. So what they do is they take the amount of credit that they receive and then they set a stop on options. Can you imagine that? Setting a stop on options? It makes no sense. Why would you set stops on options? That's like saying, I don't know how to play options. Let's set a stop. You set a stop on options of 3 times the credit you receive. So what that does is it says, okay, I'm willing to go down to $75, then I'm out of the trade. So you guaranteed a loss because the probability of touch that 3 times is very high and essentially takes your 95% probability of profit trade and turns it into a 65% probability of profit trade. So now you're going for less money, for a very tiny bit of money, with a small probability of coming into that trade and getting stopped out. I mean, this strategy is insane. Yet I see all kinds of people putting on YouTube their strategies, and everyone's following this one woman and this one guy, and they see them making money online. Of course, that's a ruse. They do not make money the way they say they do. And they're sweating every single trade. What I do is a complete inversion of their strategy. We never sweat because we risk about as much as they get in profit. We make in profit about as much as they risk. So like I said, an inversion of that strategy. Now, how we do that, well, it's relatively simple. We, instead of going for out-of-the-money trades, we go for in-the-money trades, deep in the money. And we're looking to make money on the movement, which, virtually everybody is. Actually, most zero DTE people are hoping that they'll get as little movement as possible because that's when they'll more likely profit. However, when have you known the S&P not to move? It moves all the time. So the premise of their trade is an anti-premise, one where they're hoping that it doesn't move, but they know it will, so they protect themselves, and then they are forced to get out of the trade most of the time or take a measly profit by tying up a lot of cash. Now, what I do is I do the exact opposite. We start out of the money and hope that we're going to go into the money in the direction of that trade. And the way we pick direction is our secret sauce. That's our proprietary information. I can pick direction probably 95% of the time. And even if I can't, I can change it up if we get the direction wrong and then start over again, and if it goes in the other direction. So we can pretty much get the direction just about every time. And all we really need is a small bit of movement. Now, how much movement that we're going to get and the type of trade that we put on, in other words, what the average true or expected range of movement is important to us too, determining how we structure the trade. Because if we're expecting a little bit of movement, we'll structure it one way. If we're expecting a lot, we'll structure it a slightly different way. All to more or less take advantage of that expected move. And all this is information that's readily available in your platform. It's our strategy that is more dynamic. But the key here is that we are always taking a very small amount of risk. Now, that small amount of risk, here's the important part. About 80% of the time, 75%, I think 75 is the right number. 75% of the time, that amount of risk that we have, we can get into a trade where we will duplicate or get as much profit as we have risk. So in other words, that amount of risk is the capital that we're putting up. And on average, we actually do a little bit better. We're averaging about 150 to 200% of the risk as return. Now think about that. The other zero DTE guys are trying to get 1/10 the amount of return on their risk. And they don't even go for that. When they hit 50%, they usually get out. So they're even getting less. We're looking to get 2 times our risk on an average day. On a good day, we could get 10 times. So why aren't you doing zero DTE the asymmetric way? I mean, that's really what it's all about too. The service, the site is called Asymmetric Advisor. I first started this service as an investment newsletter where we invest a small amount of money and then into stocks, into certain types of mergers and acquisitions in natural resources, and we expect asymmetric returns. And since opening that service, we're averaging some close to 400% return on our plays. When the pandemic hit, the number of mergers and acquisitions that were happening in that industry kind of dried up. They've now come back, and so. But anyways, at that point, I said, "Man, there's not a lot of work to do." So I started up this option service, and still working on the premise of asymmetric returns compared to your risk. So that's what it is. Let's see. Are there any questions here? Tesla, a huge run up to 800 tomorrow. Well, isn't Kathy Woods saying that Tesla's going to go to 3,000? Might as well just pump it all up, put it all into Tesla, right? So we need to have access to futures trading, which I don't. Well, anybody can get access to futures trading. So because you don't, doesn't mean you can't. And you don't need to have it. You can certainly do these trades in the SPX or the SPY as well. You just won't be able to take the trades early enough or early. And I don't have to take the trades early. I can take them any time during the day too. And so I can apply the same principles whether I take them the night before or 6 o'clock in the morning or after the market opens. So I can take them anytime. It's just that I have the opportunity with futures to be able to take them whenever I want. Plus, because you have the continuity of data with futures, you have much more or much greater ability to analyze the market. With the SPX, you simply can't analyze the market effectively because there is no data between the close the previous day and the open of that day. So you're flying blind on top of taking undue risk. But we can, in fact, trade any of these. And so that's really not a problem. How much credit did you receive on today's trade? $11.75. So in in futures money, there's it's $50 per point, so it would be half of that. So normally you would take like the SPY or the SPX and multiply that by 100, and you would say $1,175. But in this case, it would be closer to $600 because it's half of that. So futures are a little bit different in that regard. The other question: credit spreads or debit spreads you trade? Mostly credit spreads, but we can trade debit spreads as well. There's a distinct advantage to trading the credit spread once you get into the profitable area or the profit tent of the trade, because then time is on your side once you're there. So yeah, and quite frankly, it doesn't make a whole lot of a difference. And I guess that's it for questions. So again, we took this trade at what was it, about 10 o'clock last night, and I can show you the particulars of the trade. So I took the trade right about here, and we get out right about here. Now, I got out kind of early, and I could have stayed in. I thought it would go this high, but at the time, in the pullback and consolidating a bit here, I felt like, well, maybe I can just take my profit there. So I only took about $3 of the available $11. So here's the trade right up here. You can see we started with $11.75 credit, exited with $8.75 credit. And we opened the trade at 10:03, and I closed it this morning at 10 o'clock. So we were in the trade for 12 hours, but I slept for 8 of those hours. And I could sleep on it because, the risk was so small. I mean, imagine that. You put on a trade and you fall asleep for 8 hours and not worry about it. And that's what I'm able to do with the 0 DTE inversion of risk strategy. All right. Well, I hope I hope this was useful to you, and you see the benefit of trading this way. Small risk for huge gains in one day. Now, I'd say that the only mistake that we made today is that had I stayed in the trade, it looks like it's going to easily end up in the profitable area, and I could have made about $600. Instead, I made about $150. So, oh well. That's the way it goes. All right. Thank you very much. And we're going to say goodbye now. We'll see you on Wednesday with our next trade.